Let's jump right into this deep dive on the explosive 500% intraday move for CID HoldCo, ticker symbol DAIC, and uncover exactly why this wildly volatile stock might just be the ultimate financial mirage.
So on the surface, DAIC's operating business, they call it .A, looks like an absolute powerhouse. They're basically promising to revolutionize industrial supply chains. How? By combining Internet of Things hardware, RFID, Bluetooth, 5G sensors, with real-time tracking and AI cameras. It's a fantastic core idea. They want to use IoT data to track exactly where physical assets are and what they're doing, and then use predictive analytics to optimize the whole workflow. It fills a huge blind spot that traditional software just misses. And here's the big kicker. They're trying to pivot away from selling low-margin hardware and transition into a high-margin, multi-year software-as-a-service model. In the enterprise world, that SaaS pivot is the holy grail, right? Because if you pull it off, you get those premium valuations thanks to predictable, recurring revenue that just compounds over time.
Now, you might be wondering if this is all just vaporware. Actually, scratch that. It's not. I'd give their underlying technology potential a solid 7 out of 10. Layering AI object recognition on top of real-time tracking, that creates an incredibly rich data layer. Plus, they've got strategic partnerships with massive players like Wiliot and Worth Industry North America. And that's huge, because those partnerships act as a total shortcut. DIC can just piggyback on these established global distribution networks instead of spending a fortune building a sales pipeline from scratch. If they can roll out the hardware and lock customers into those sweet, non-cancelable SaaS contracts, their margins could theoretically go to the moon. So the standalone tech story, it's genuinely strong. But, and this is a massive but, this compelling story recently triggered a totally wild intraday spike. We literally saw the stock rocket from about 43 cents to over $3 in a single day. Nearly 49 million shares traded hands. But listen, do not let those flashing green numbers fool you. This explosive move was driven purely by microcap speculation and extreme low-float dynamics. What happens is, a tiny catalyst triggers algorithmic trading bots, creating this massive synthetic supply and demand imbalance. Short sellers get squeezed, day traders pile in, and the price just violently shoots up. It has absolutely zero connection to any real improvement in the company's fundamental value. It's just a chaotic speculative frenzy, and spoiler alert, those almost always end in a brutal, punishing crash. Okay, so here's where reality hits hard. Despite all that SaaS hype and promises of $15 to $25 million in 2026 revenue, guess how much DAIC actually generated in the first quarter of 2026? $12,214. Yeah, let that sink in. 12 grand. To put that into perspective, in the exact same quarter the year before, they did over 350,000. This absolute nosedive is a classic, if brutal, symptom of a company trying to do a hard pivot from legacy hardware to a brand new SaaS pipeline. Management says, oh, the revenue's just delayed, it's going to aggressively ramp up later in 2026. But come on, in the markets, we need to see actual reported revenue, not just empty promises. And this severe mismatch perfectly illustrates the catastrophic financial reality hiding behind all that shiny AI tech. The company burned through roughly $4.1 million in operating expenses in just one quarter to generate 12 grand in revenue. That capital is just being incinerated by heavy administrative costs, massive executive compensation, and the intense R&D needed for their platform pivot. All that just to produce a gross profit of less than $10,000. They had a net loss of nearly $4.5 million for the quarter. You just can't sustain a massive corporate infrastructure when your actual cash flow wouldn't even cover the payroll for a local coffee shop. Even when we zoom out and look at the annual data, the picture is just grim. Sure, you see a massive percentage jump in 2025 revenue, climbing from basically nothing to $5.8 million. But look at what it cost them. Their bottom line net loss is absolutely hemorrhaged, ballooning from $21.5 million up to nearly $37 million. Now, in venture capital, we always talk about the SaaS J-curve. The idea that customer acquisition and R&D will drag profits way down before recurring revenue catches up and rockets the business upward. Well, DIAC is currently stuck flat on their back at the very bottom of that J-curve, and they haven't shown any ability whatsoever to make the upward swing. The harder they try to grow, the faster they bleed out. So, where does that leave them? Right in the middle of an immediate existential crisis. At the end of March 2026, they had a measly $850,000 in cash. Against that, a staggering $11.87 million in total liabilities. Their shareholders' equity is underwater by $4 million. They did report a tiny positive operating cash flow of $94,000 that quarter,
but honestly, that was heavily padded by favorable shifts in accounts payable. In plain English, they're likely stretching out their vendors and severely delaying paying their everyday bills just to keep the lights on. Make no mistake, this business cannot sustain itself. They are running on absolute fumes. To survive this severe cash crunch, they grabbed onto the absolute most dangerous lifeline in the public markets: toxic convertible financing. They cut deals with lenders like J.J. Astor and White Lion Capital that include some wildly shareholder-unfriendly terms. Let's break this down. Some of this debt converts into equity at a 20% discount to the stock's volume-weighted average price. It creates a toxic death spiral. When the stock price drops, the conversion price drops with it, meaning the lenders get substantially more shares for the exact same amount of debt. And you better believe opportunistic short sellers front-run these conversions, pushing the price down, knowing a flood of new shares is coming. Those shares hit the market, the price tanks further, which triggers even more aggressive dilution. It literally crushes existing common equity to dust. But the absolute nail in the coffin might just be this number right here, a $1.057 million default notice. In August 2026, things went from terrible to disastrous. Their secured lender, LHIT, officially called a default, claiming DAIC failed to make minimum monthly payments dating all the way back to January. The lender demanded the immediate assembly of collateral and made it clear they intend to exercise all available remedies. Now, in a corporate default, assembly of collateral isn't just a scary legal phrase. It means the creditor can literally swoop in and seize the core business, draining the bank accounts, taking physical possession of proprietary hardware, and even claiming the intellectual property itself. I really cannot stress this existential risk enough. DAIC explicitly warned investors in their own filings that they expect the lender to proceed with foreclosure. Think about that. A material portion of their actual physical operations could be forcibly taken by the creditor. For a tech company trying to pull off a SaaS transition, this is a fatal blow. If the lender forecloses on the core IP, unplugs the servers, or seizes the inventory needed for those big partnerships, the entire business model just goes poof, it evaporates. And without those assets to generate future cash, common equity isn't just impaired, it is wiped out completely. Zero. And the dominoes are just continuing to fall all over the place. In July, a desperately needed $6 million preferred stock financing deal, which was supposed to be their ultimate survival bridge, was suddenly terminated by the lead investor. Boom, gone. Then they announced their Q2 financial filing would be delayed. Now, if you've been around the block, you know a delayed 10Q is a massive, screaming red flag. It usually points to severe fights with auditors, major internal control failures, or them frantically drafting terminal going concern warnings. It hides their actual cash situation right when transparency is most critical. Throw in active Nasdaq delisting proceedings because their market value tanked, and you have a perfect storm of cascading failures happening all at once. Also, please, do not let their recent 1-for-25 reverse stock split fool you into thinking this stock is recovering. Look, if a company takes 25 of your 4-cent shares and magically swaps them for a single $1 share, they haven't created a single dime of actual value. It is 100% a mathematical illusion. It's just a desperate parlor trick used by distressed microcaps to artificially pump the share price up just enough to satisfy Nasdaq's $1 minimum bid requirement. Historically, these reverse splits in distressed companies are immediately followed by ruthless short selling. Why? Because the market knows the split is just a band-aid. It does absolutely nothing to fix the insane cash burn, the debt defaults, or the lack of real revenue. When we tally up this absolute disaster of a perfect storm, my proprietary risk scorecast is just a blinding sea of red flags. This score aggregates cash runway, debt ratios, and capital structure to give us an objective look at corporate health. Now, the business and tech risks are moderate because, like I said earlier, the AI and IoT concepts actually have real merit. But the capital structure risks, they are completely off the charts. Financial risk, liquidity risk, dilution risk, Nasdaq risk, and bankruptcy risk are all maxed out at a 10 out of 10 extreme danger level. The really cool story of their innovative technology has been completely hijacked by the mathematically brutal reality of their distressed balance sheet. Ultimately, if you are putting money into this stock right now, you aren't investing. You are gambling on a purely binary outcome. The bull case demands absolute perfection. They have to somehow dodge foreclosure, win a Nasdaq appeal, find non-toxic funding, and miraculously accelerate their SaaS revenue overnight. If they pull off that miracle, sure, massive upside. But let's talk probability. The bear case is vastly more probable based on everything we know about distressed debt. It's incredibly likely that this liquidity crisis leads to foreclosure, the operating assets get swallowed by the lender, the stock gets delisted, and common equity gets completely, entirely wiped out.
So the final provocative question you really have to ask yourself before buying into this 500% tech mirage is this. Even if their AI technology is brilliant, and even if those supply chain contracts eventually do materialize, when the secured creditors, the toxic debt holders, and the preferred investors are finally done picking the bones of DAIC clean, is there going to be a single scrap left for you?